We are taking a real close look at market structure. And I recently started, engaging on Twitter, and to some of those Twitter followers that are writing about dark pools. We are looking very closely at this market structure that so many of our orders, retail public orders, are not going to the lit markets, but are going to internalizers, going to wholesalers who are taking the retail public's trades rather than sending them to the stock exchanges.
That was SEC Chair Gary Gensler speaking exclusively to CNBC earlier today about the retail investor. But our next guest says the SEC needs to do much more to level the playing field. Let's bring in Dave Lauer, former Citadel trader and CEO of Urban AI. Dave, great to have you with us.
Thanks so much for having me on the list. I appreciate it.
It's nice that Gensler is engaging with the Twitter community, but I know from looking at the Twitter community's comments about what Gensler said today that there is a lot of skepticism about whether or not the SEC can or will, in fact, do anything. From your perspective, what do you think is the number one thing that the SEC should be focused on when it comes to this particular matter of routing order flow to wholesalers as opposed to lit exchanges?
Yeah, I appreciate the skepticism. I've been sort of in this conversation now for almost 10 years, and I've heard about holistic reviews of market structure and the need to study. And I feel like it's something that we hear a lot of and we see little action. And I think the most important thing that we should be focusing on from a market structure perspective is the fact that almost half of all trading is happening off exchange. And in some retail heavy names, you're seeing more than 70% of the volume executed in these internalizers or wholesaling systems. And that's damaging the markets. It's widening spreads, and it's a significant information advantage for those two firms, Citadel and Virtu, who operate a de facto duopoly in the internalization market. So I think that we should be looking at better disclosures, and I think we should be looking at rules similar to other countries. This isn't a controversial thing. Canada, Europe, the UK, Australia all have very strong rules that prevent the internalization and off-exchange execution of small orders while preserving that functionality for institutional orders.
David, Karen, thanks for being on. So just so I understand clearly, when you talk about disclosure, are you saying make the dark pools transparent and that should help solve the problem?
Well, I would like to see more transparency, but I think we've done a good job there. When I think better disclosures, I'm thinking around short positions and derivatives, that type of thing, the issues around failures to deliver and naked shorting. I think we need much better disclosures in that area, which is a major area of concern. And then in terms of off-exchange trading, I think we should require material price improvement for small orders for off-exchange trading. And in saying that, I'm only echoing what Citadel said in a comment letter in 2004, where they made the identical arguments that I'm making here.
Someone would argue, Dave, though, that with payment for order flow effectively, but the notion that retail orders, retail trades are routed to internalizers and wholesalers instead of lit markets, that they are getting better pricing. Is there truth to this?
They're getting better pricing relative to a wider spread. And this is so important to understand. The way that we route orders for retail, it means that those orders do not go to lit markets. And by taking those orders away from lit markets, you widen the spreads because everyone wants to trade against those orders. Those orders are profitable for market makers. So all I'm arguing is that we should have open competition for order flow. That should not be a controversial thing in capitalist markets. Get those orders onto exchanges. Let all the market makers compete for them. You would tighten spreads, and you would still get price improvement and size improvement for those retail orders. So I'm convinced that net, we would see far better execution quality, even for retail, let alone for institutional asset managers who would benefit from those tighter spreads by 25% or more.
So basically what you're saying is that right now the system is such that you might get a better price, but that's like saying you're getting something at a 20% discount after it's already been marked up 40% or something like that. Right? I mean,
exactly.
Basically, yeah. It looks better, but it's really not because that spread is so wide.
That's right. And if you look at other markets around the world, they actually have lower execution costs than the US if you compensate for the fact that the US market is much bigger and you control for company size. But I've seen reports that show that execution costs in markets with less off-exchange trading are lower. And that's what we should aspire to in the US.
Dave, great to have you with us. Thanks for joining us.
Thanks for having me.
Dave Lauer. Tim Seymour, I know some have made the argument on this show that things have never been better for the retail investor. Do you still stick by that at this point?
Well, look, I think there's a comment here that you can make an argument that this duopoly that exists, and I'm not sure how we got here, and it's a long story, but that this is affecting all market participants, and that there is at least an institutional bias in that, yes, some of the larger orders could get routed here, and I think there's an ability to actually see who's who. But yes, this higher cost dynamic is something that, look, it's impossible to really measure where they would be if the market didn't exist with the dark pools with just two players. Clearly, I still think the retail investor, both in terms of their access to information, their ability to trade for free, and the bid ask, is not at a massive disadvantage to institutions. And in fact, I think the gap's never been narrower. This is a market dynamic, and I think this affects both institutions and retail players alike. And I think that's Dave's